When we talk about funding the retirement lifestyle, there are a few paths we can take. Superannuation, that pot of gold that we've been contributing to during our working years, personal savings, the investments, the extra cash we've stashed away or invested outside of our super, and government age pension for those eligible, a helping hand from the government, and annuities. Annuities are like the mysterious characters of the investment world. Everyone's heard of them, but not many know their real story. So in this video, let's find out what an annuity is, how they work, what to watch out for when considering it. So, what's an annuity? An annuity is similar to a term deposit. You exchange a lump sum of money for a guaranteed series of cash payments. However, I have to point out that an annuity is an insurance contract. They are essentially the opposite of a life insurance. When you buy a life insurance, you are spending money, paying monthly premiums to protect your survivors against the risk that you'll die too young. On the other hand, buying annuities protects you against the risk of outliving your money. So it functionally might look similar to a term deposit, a type of investment, but I would rather look at it as an insurance. There are typically two types of annuities. The term annuity, fixed term annuities have a specified term, for example, 1 to 20 years, and term annuities may or may not include a payout of the remaining money at the end of the chosen period. You can also get a lifetime annuity which pay you a monthly payment for as long as you live. And payment can start immediately or on a future date, which is called a deferred lifetime annuity. Will you get your capital back? Well, traditional lifetime annuities historically required investors to commit a lump sum in exchange for a guaranteed income for life. And this approach, while offering financial security, had a significant limitation. Once the investment was made, the investor had no access to the initial capital, which had caused a lot of concerns. Nothing would be returned if they died earlier than the average. Nowadays, many lifetime annuities offer death benefits until the average lifespan. Despite paying lower income, lifetime annuities that provide access to capital have generally been more popular than those that do not. Some of these annuities now offer the option for retirees to withdraw a portion of their capital before reaching the average lifespan at the cost of receiving a lower income. You can also buy annuities that offer inflation adjustments, and this is normally common in lifetime annuities, and inflation-adjusted annuities would be very handy in a high inflation environment to ensure the payment doesn't shrink in its true value. You can use your super or savings to buy an annuity from a super fund or life insurance company directly. You can also buy an annuity in joint names, and this allows income splitting for tax purposes. If you or your partner dies, the survivor has ownership and access to the fund. You can also choose to be paid monthly, quarterly, half-yearly, or yearly. For some term annuities, you can structure the maturity value you will receive when the annuity expires. For example, say you have $200,000 and want to use $20,000 for that each year for 10 years plus the interest. You can establish a 10-year annuity where the maturity value is zero. Every month, you will receive a payment into your bank account representing the interest on your money plus some of your own capital returned to you. Upon purchasing an annuity, you have the option to nominate a reversionary beneficiary or select a guaranteed period option. A reversionary beneficiary is typically a partner or dependent who will continue to receive income payments upon the annuitant's death, usually at a reduced rate. Or you can sign up for the guaranteed period option, and this option establishes a minimum payment period. Should the annuitant pass away within this period, a death benefit is payable to the estate, either as a lump sum or continued income stream. However, if death occurs after the guarantee period's conclusion, payment cease and no death benefit is issued. Opting for a longer guaranteed period results in a lower regular income payments, and once chosen, this agreement is fixed and cannot be altered. In Australia, annuities can only be provided by life insurance companies, and these companies are regulated by the Australian Prudential Regulation Authority. When you invest in an annuity, your capital investment goes into a fund along with the capital received from other annuity customers. And this fund is known as the statutory fund, and all regular payments to the annuity customers are paid from this fund. This statutory fund is required to hold enough capital to withstand a significant share market stock event. It's critical to point out that annuities are not covered by the Australian government's financial claims scheme, which protects certain types of deposits in the event that a bank, building society, or credit union fails, which is currently up to $250,000 per account holder per bank. There are a couple benefits that make annuities attractive to retirees. Number one is the security. An annuity can solve a lot of the challenges associated with retirement. If you happen to live for a long time, lifetime guaranteed cash flow provides protection against longevity risk. Imagine getting a paycheck even after you retire. That's what an annuity can do. You give a company some money now and they promise to pay you back a little at a time for years or even for the rest of your life. It's like having a never-ending income stream, which can be pretty comforting. Number two, it offers a higher withdrawal rate. The payout rate for an annuity is typically higher than most withdrawal rates that any financial planner advises, which is typically 3.5 to 4%. This is because an annuity provider, the insurance company, gathers a large pool of customers, so it is not a problem that some people will live long lives, some others will die early. The annuity provider is more concerned with the average lifespan. We can think of this payout rate as the interest compared to government bonds and term deposits. Essentially, annuities are corporate bonds issued by insurance companies, which tend to have lower credit ratings, therefore higher yields. And annuities can provide tax efficiency. If you buy an annuity with your retirement fund in Australia superannuation fund, you won't have to pay taxes on it once you're over 60. Who doesn't love saving on taxes? And annuities can provide inflation protection. Some annuities adjust for inflation, meaning your payments increase over time to keep up with rising prices. On the flip side, we need to know the drawbacks of annuities. Number one, you might miss out on better returns. Annuities are not investment, so your capital would not grow. Therefore, you cannot take advantage of favorable market movements, although the insurance company will. You are locked into a specific rate of return for the rest of the term or life. If interest rates rise, you are not able to take advantage of the higher potential return. Annuities can be quite rigid. Once the annuities is established, the amount and frequency of the income payments cannot be altered, and you cannot pass on to your estate like any other assets. And it can be complicated. Annuities come with lots of options and rules which can make them tricky to understand. And customers who buy annuities have to bear the credit risk from the insurance company. Although in Australia, life insurers are regulated by some authority, but the customers still have to bear the credit risk if any of the insurance companies go bust. Annuities can potentially affect age pension payment. The income of an annuity is assessed by Centrelink income test, which could potentially affect your age pension payment. Annuities purchased within superannuations are counted against the transfer balance cap, which is currently 1.9 million. The last drawback is lack of competition. At present, only a few companies are offering lifetime annuities in Australia, which could lead to higher prices due to a lack of competition. Thinking about whether an annuity fits into your retirement plan, it boils down to your personal financial situation and what you are hoping for in retirement. Let's walk through some questions to help you figure this out. Would I have enough super fund by age 67 to have a comfortable retirement, which are $690,000 for a couple and $595,000 for a single person? If there's a bit of gap between what you have and what you need, do you have savings or other investments outside of super to make up that difference? Or are you counting on some help from the government age pension to cover your living costs? After you ask all these questions, then you can consider maybe some amount could be allocated to an annuity instead of government bonds, although you have to trade off some credit risk for the high interest. Typically, you want to start the annuity in a time of attractive interest rates, then lock into that relatively high rate. For example, if you see the historical cash rate, you would want to lock in the higher annuity rate around 1990 if you retire around that period when the interest rate is going downhill. Not the other way around. During the pandemic 2020, you would be better off leaving the money in the bank account, which could give you more interest. At the end of the day, it's important to remember that you don't have to take an all or nothing approach. You can have a mix of options from super fund, individual shares outside of super, annuities, government bonds, term deposit, and even cash. There are some insurance companies that offer annuities in Australia. Challenger and AIA's Resolution Life are two of the largest ones, along with Com Insurance, First Choice, and Generation Life. Some offer transparent information on their websites, but you need to contact others for quotes. Commonwealth Bank's insurance company, Com Insurance, annuities are via the Colonial First State's First Choice. So what's your take on setting up an annuity as part of your retirement plan? Are you leaning towards the security they offer, or do you prefer other investment vehicles? Drop a comment below with your thoughts. My name is Ira. I'll see you next week. Bye.